Well, hello and welcome to another video in the series where we're focusing on the quantum market strength indicator, the MSI. If you followed so far along in the series, we've looked at stocks and ETFs and index futures as well. And in this one, we've moved on to another market, which is commodities. The two differences here, first of all, I've gone to slightly slower timeframes, or much slower timeframes, in fact, because I just wanted to show the indicator working not simply in the faster timeframes, but also the fact that it works in the slower timeframes in precisely the same way. So I've gone to the dailies, the weekly, and the monthly here on the three variants. But in addition to that, we also have a fourth here. And right over on the left-hand side, you can see we have a single line, which is the UUP. Now, if you're not familiar with the UUP, this is an ETF, and it's an ETF which gives us a very clear view on bullish sentiment towards the dollar. So when the US dollar is rising strongly, so will the ETF, the UUP. And as you can see, I just have this on the chart. Again, it's the daily time frame. And the reason I've done that is, once more, to get across this aspect of relational views, not only of relational in terms of time, but also in terms of related markets and how these markets interact with one another. We are constantly looking, as I've explained in previous videos, for the market strength indicator. We apply and use it in many different ways. We perhaps are looking for confirmation through groups of indices or stocks or ETFs or whatever it may be, or markets indeed, that are either moving in the same direction, where we want to see that sentiment moving universally through a group, or alternatively, perhaps we are looking for divergence. We are looking for one aspect of a market which is moving higher and one which is moving lower, as indeed we saw with stocks and related to the VIX. And this in many ways is very similar to that, because I've broken out the dollar and represented it with the UUP on the left-hand side to really demonstrate this facet of the correlations between various financial markets. And can I also state that whilst these correlations are often strong and do hold, they are not cast in stone. There is no guarantee that when we see the dollar moving in one direction or the other, that commodity markets will automatically move in the inverse way. So when the dollar is rising, typically we would expect to see commodity markets falling, and equally vice versa. But correlations do break down. They are not guarantees of relationships. They break down for many reasons, not least because the dollar is it's the currency of first reserve. It's also a risk currency in its own right, and it has many forces which drive it. So don't rely on these correlations as cast iron guarantees that when a particular aspect of the dollar in any time frame is moving strongly in one direction or the other, then the associated commodity that you happen to be looking at will move inversely. It probably will, but there is no guarantee. Now, what I've set up on the time frames here on the other three charts is we have four of the commodities. We have copper, which is this one, which is HG. We have silver. We have oil. And we have gold down at the bottom. And as you can see, I've tried to color code them so that it makes it easier to spot which is which. But as a general view, as you can see, this is August, so we're just coming out of July here into the start of August, and really pretty much from the start of August, certainly from within the first few days of August at any rate, the dollar has been rising and rising quite strongly. And you can see that reflected here in the associated commodities, because we have particularly, we've got copper here at the top, getting quite overbought at that point. And then all of them really rolling and falling quite strongly as we see the dollar rising here. And you can see that reflected on the weekly. This is August here. So this is really the top point of the trend higher for commodities at that stage. And we see silver rolling over here, as indeed are the others. Less so perhaps with oil, which was climbing at that point. And finally, right out onto the monthlies. August is here. And you can see we've practically got well over a year here of data. And the other point about the monthly chart here is the overextension of oil. Oil was very, very strongly overbought at this point. You can see how high it is on the indicator, almost up at 100. So it's very, very strongly overbought. And at some point, it will reverse. It's not a question of if it'll reverse, it's a question of when. And as I've explained in some of the other videos, using the indicator and taking opportunities, there are many and varied opportunities. We can look at reversals, but if you are going to be a reversal trader and look at those reversal opportunities, as I've said before, there's two things. First of all, you have to be patient because the commodity, the stock, the ETF, whatever it is, may well remain at that level for some time, and therefore you have to be patient. And the second facet of it is that you have to set a wider stop loss to allow for that oscillation, that consolidation of price, possibly associated with some volatility, but certainly a sideways move where the price will oscillate. And therefore, you have to set a wider stop loss in order to accommodate that. The payoff, of course, is that in putting more risk on the table, you are then getting into a reversal trend at the earliest opportunity and therefore maximizing your advantage. And that's how trading and investing works. The greater the risk you're prepared to consider and put on the table, then the greater should be your reward. And that's how it works in terms of trading off reversals. So if you have the patience, and this can be any time frame, we're looking at a monthly time frame here, but this could be on a 5-minute chart, an hourly chart, it makes no difference. The principles are exactly the same. You would still have to set a stop loss of relative width in order to allow for that consolidation of price at that level. But then once it starts, you're in at the ground floor level, if you like, and you are maximizing whatever profit the trend will deliver for you. If you're a trend trader, then you're looking at the indicator in the sense of how steep are the lines, because the steepness of the line will indicate the strength of any trend that's developing thereafter. And you are jumping on that trend once it's underway. But the quid pro quo is that clearly you don't need to set such a wide stop loss because the trend has some momentum to it already. You are jumping on a moving train, and therefore your risk is that much lower. But then so is your return, because you've given up your right, if you like, to the early part of the trend, which has already passed you by as you've waited for it to build up some momentum, and then you've taken that opportunity to jump in. It's all down to your view of risk, your attitude to risk and money management, how much you are prepared to put on the table, and how long you are prepared to wait. And patience is a big thing when you're trading reversals. And as I say, it's all relative. Patience on a 5-minute chart, you might have to wait 15, 20 minutes, half an hour. Patience on a daily chart, you might have to wait days, maybe even weeks. So it's all relative. But I wanted to just create this workspace for you to highlight, first of all, the relationship with the dollar, to really to give you some ideas to start to think about how you can set up the indicator with the dollar accessed. And in this case, it's an ETF. So we've used the UUP here. So you don't need to necessarily have spot charts or futures charts, whatever it may be. We've just gone straight to an ETF, which is great. And then to really show you the relationship between the commodities themselves, how generally speaking they will move together, but not always. Typically, you will see, for example, silver and gold will tend to follow one another around fairly closely. But you also have to be aware that silver is an industrial commodity as well as a precious metal, and therefore is also driven to some extent by commercial pressures, commercial demand, supply and demand for the metal, because it's used hugely in industry in many different applications. whereas gold is gold and really it just has that precious value to it, as well as being driven by inflationary pressures. Also, oil, we know all the supply and demand issues with oil. We're very familiar with them. We're very familiar with the whole idea of how oil gets to market, the demands for oil, and of course, OPEC is at the center of that, managing everything globally. Of course, highly political and influences supply and demand greatly. So I think an interesting way to use the MSI, the market strength indicator, in this way. And what I've now done, as I've done in the other videos, I've now taken out one of those commodities and we'll look at it in isolation. So let's do that next. Okay, and here we are on the workspace, which I've used before. On the left-hand side, and I've gone to faster timeframes here, and we've isolated out oil, which is the CL contract for October. On the left-hand side, we have our market strength indicator with simply oil on it, and that's on 5 minutes. And then over on the chart, the time charts, we've got the 3-minute, the 5-minute, and the 15-minute on the top line. That's for oil as well. And then down on the bottom, just to give you a different view, if you like, rather than UUP, all I've done here is put the Aussie dollar from the spot forex market to just give you a sense of the inverse relationship, that very clear inverse relationship, which you can see here with regard to the US dollar and the price of oil. And as the Aussie dollar falls, then clearly that is signaling strong dollar buying. And we've got that pretty much universally across the time frames from the 3 minutes, the 15-minute. And that really starts around here at 8 o'clock. And this is 8 o'clock on this chart. And we've got 8 o'clock on this chart here. And really, that's it. You can see the interplay between oil prices and the dollar. And on the left-hand side, you've got a strong signal as we build from the bottom here of oversold for oil, and we move up in this very strong trend. Remember the inclination of the lines on the indicator in exactly the same way we have done on over many webinars, certainly in terms of the Forex world on the currency strength indicator. The principles here with the market strength indicator are exactly the same. We have overbought and oversold regions where we're looking at potential reversal opportunities. And then we also look at the strength of the trend that is developing. How steep is the line? And the steeper it is, the sharper the line, higher or lower, then the stronger is that trend. And we can see all that unfolding here. We had this very strong trend, which took hold earlier in the day and also confirmed, obviously, with our falling currency pairs as well, the majors signaling strong dollar buying at the same time. And of course, underpinning all of this, we have our volume price analysis methodology, reinforcing everything for us and giving us that all-important perspective on confirming the strength of the trends, the buying that's coming in here. You can see over here on the 15-minute time frame, we have a really nice hammer candle here, lots of volume coming in. Then we get lots of volume in this very strong uptrend where we move from 78.40 up to 79.80 and on to $80. Very good supportive volume, nice wide spreads to those candles. We break through this potential resistance region and on up we go to the close of business at the end of the day, with the volume tailing off as we come to the close of the session, which is no great surprise. So a really nice example, which I wanted to pick out for you and really highlight again. Again, this indicator is all about trying to use it in a creative way. And that's really what I'm trying to convey in all these videos, to give you some ideas to think about for yourself. So really, this is a sort of seedbed, if you like, to get the thought processes flowing and really give you some insights and ideas into related markets and how we use them in combination alongside the market strength indicator, where we can pick off individual elements as we've done here, or we can look at groups. We can look at whether we're trading with the stream, with the river of sentiment, or are we actually moving against the river of sentiment, which is fine on occasion, but we need to know that facet, obviously, when it unfolds. So I hope you've enjoyed this particular video. Lots more to come as usual. Thanks for watching. See you soon, and bye for now.